Hello, everyone. Good evening, and welcome to our new educational session today, How to Trade Gold, presented to you from ONEPRO Market Research and Trading Department. This is Mohanad Yakout. I'm your Global Head of Market Research at ONEPRO. And basically, it has been quite some time since we had any educational webinars or sessions online to provide you with more information so you could tackle the markets with success and ease. However, today we're going to talk about gold markets. I prefer to start with gold. Basically, we'll be having more sessions later during the whole month of Ramadan. However, just because gold especially is the most traded financial asset in the trading industry, because we have a lot of traders interested to trade gold, how to trade gold, what are the different types of contracts, what are the factors influencing gold movements on the short and the long term, etc., etc. Not only traders in the financial trading industry, however, we also have investors looking to invest into gold on the medium and long term. We also have countries increasing their gold reserves in the central banks, and we will get to know today what are the gold reserves in any of the central banks globally, and why is it important for any country's financial stability, etc., etc. So basically, I prefer to start with gold because it has a lot of interesting topics to cover. We have got a lot of questions from you traders about this gold topic specifically. So yeah, we are here today to discuss all what you need about gold. Today's session basically will be divided into two parts. The first part should be covering the gold market from the fundamental aspect. I mean, what are the economic indicators that influence the gold movement? We hear a lot about interest rates. We hear a lot about unemployment rates, global financial crisis. We hear about COVID-19 and what happened back in 2020. So I don't want you to be someone who's interested into economics or fundamental analysis. However, if you're really going to trade gold, you must at least understand the basics of trading gold when it comes to the financial and the fundamental analysis, and as well as the economic analysis. So what are the economic crises that basically affect gold prices? We will be discussing briefly what happened back in COVID-19, what happened back in the Russian invasion into Ukraine, because if you want to know what will happen in the future, you have no data to study except for the historical price data. So that's what we'll be doing today. During the first part of our session, we will be discussing quickly what happened and what influenced gold prices movement during the past 2 or 3 years. And the other part will be, let's say, the other part of the session will be to discuss the gold technically. We will be having a quick and a very detailed brief on the technical analysis side on gold prices. What do we expect on the short as well as the long term? How could you trade gold profitably given all of the geopolitical tensions, the banking financial or the financial system instability at the moment, the risk off sentiment? What does it mean even to have the risk off sentiment, etc., etc.? So we will be discussing the fundamental aspect during the first part of the session. Going forward for the other part, we will be having a full detailed analysis on the fundamental, on the technical side of things, and we'll be going through the technical on the daily, monthly, weekly time frame and all of the time frames today. So let's start quickly and let's answer a very important question to start on our session today. Why is gold regarded as a safe haven? What does it mean, safe haven? Because when you're trading in the financial industry or the financial markets, you will have two types of instruments. There are instruments which basically can provide you with high profits. However, it comes with a high risk. And you have another sort of instruments which can provide you with a little bit, let's say, lower profit. However, it's safer assets. As a general rule of thumb, the higher the risk, the higher the potential profits. So when it comes to talking about gold, gold is basically the top safe asset regarded in the financial markets. It's always referred to as the safe haven assets. So why is that? By having a look on the price history on gold, you can definitely spot, and we will see this on the chart in a moment, you will definitely spot during any crisis that happened when it comes to the economic cycle globally. When it comes to geopolitical tensions, when it comes to any wars between countries, let's say, for example, Russia and Ukraine, when it comes to any health crisis, just as what happened back in COVID-19 in 2019 and 2020, during those periods, basically, you will have an upward surge on gold prices. And this is why it's basically mentioned as a safe haven, because whenever you are unsure about what will happen in the short or long term in your economy, if you're unsure what will happen to the value of the money that you are having in your bank, investors directly just rush to the gold prices or to buy gold. And this is why basically we have those upward moves on gold prices during the periods of unease, or let's say risk off sentiment, risk aversion sentiment. So the yellow metal is considered a safe haven for investors and even individuals in the event of market volatility or even political risks and other factors that leads to huge price increases. This leads to a huge reduction in people's savings and the value of the local currency. Let's say if you're a millionaire, okay, even if you have millions of dollars, what will happen to your savings, to your wealth or fortune, or to your savings in your bank if for any reason the US dollar or your local currency that you are saving your money in basically loses part of its value? And this quite happened during the past couple of years, especially in emerging markets. If for any reason the value of the currency that you are saving your money in lost 5% or 10%, if all of your money is only in this local currency, this definitely means that your fortune or your wealth just decreased or has been devalued by 5 or 10%. So in order to avoid this from happening, especially in the periods of volatility, people should refer to gold to save their capital or to save the value of what they own, instead of losing 5-10% on the local currency that you're having in your local bank. Basically, in the periods of volatility, referring to gold can save you a lot of money. Not only save you money, but can also make you profits. So if you are unsure what will happen to the local currency that you're having, you can refer to gold. It will save your capital and it will store your value of your fortune and your wealth. Therefore, many people resort to exchanging their money for gold in order to preserve the value of their capital if expectations increase that the economic, political, and even military crises will persist. This happened also as well during COVID-19 crisis, and we'll discuss this shortly. However, let's talk about inflation. Inflation means that the value of the currency that you're having is going down. If you can buy some sort of basket, let's say, of goods and services today for $100, if the same basket of goods and services you will buy again after 1 month, however, with a little bit more than $100, so this means that the dollar value is going down, or economically speaking, the inflation is going up. So if inflation is going up, people basically should refer to gold, because the US dollar, the euro, the pound, whatever the currency is, it's losing its value. So we are basically referring to gold to store our value of what we own in basically our banks. However, back in 2021 and 2022, we had record high inflation numbers in the US, Europe, and let's say Britain, UK, and nearly everywhere in the world. The US basically saw inflation numbers that was the highest in 4 decades or more than 40 years. The same as well applied in Europe. UK is still challenging to find inflation that is double digits, more than 10% inflation on an annual basis. So those are very, very big numbers for inflation. However, during this period, I mean 2021 and 2022, gold prices weren't going up, they were going down. And the currencies on top of that, of course, is the US dollar. It was basically going up. Why is that? Because the Federal Reserve basically was raising interest rates. What does it mean to raise interest rates on the US dollar? Let's say If today you have some gold, okay, it's preserving your currency or your fortune, as we mentioned. However, on the other hand, the Federal Reserve, which is the central bank in the United States of America, is raising interest rates on the US dollar. This means that if you buy US dollar and if you store your money in US dollar terms, you will be having interest paid to you because you are having this US dollar. So right now, gold is not only storing your capital, however, it's a non-yielding interest or non-yielding financial instrument. So that's why during this period, 2021 and 22, people basically didn't refer much to gold. They referred to the US dollar because the Federal Reserve was raising interest rates, promising people to give more interest if they held the US dollar, and that's why that was the investor psychology. Yeah, we need interest rates, higher interest rates on the US dollar, and that's why we had this move to support the US dollar. However, this is the basic reason. We do have many reasons. We have some other expectations markets were expecting from the Federal Reserve. However, just to put it straightforward, in the main reason, the hikes in interest rates that the Federal Reserve has made and raised them again and again is the most obvious explanation, and this is logical. If gold does not pay you any interest in exchange for holding it, as we mentioned, gold back at that period was basically a non-yielding financial instrument, then why not switch to the alternative, which was back then the US dollar, that does this thing, which is providing you with interest rates and returns you more income while continuing to raise interest. Currently, the US interest rates on the US dollar is 5% roughly. So you will just get 5% of your money if you stay having or if you hold on to your positions with the US dollar. This is the mentality of most investors, which makes gold weak at times with high inflation. However, by the end of 2022 and the beginning of 2023, this is basically the chart of the US or the gold versus the US dollar. We can see this high that was formed here around 2010 or 2010 dollars per ounce, and we'll get to know why this basically happened. However, the basic or the general rule of thumb is any political crisis, any geopolitical tensions, any major or global health crisis, just as COVID-19, all of those volatility factors basically supports gold on the short and the medium term. However, we mentioned at the beginning of this session that it's not only you as a trader in the Forex market who's looking to buy or sell gold, it's you as a day trader or an intraday trader. Investors on the short, medium, and long term are also looking to buy and sell gold to make profits. And the third thing is countries as well buy and sell gold to make sure that their financial system is stable. When countries buy gold, basically this is called the gold reserves in the central bank. So what is the meaning of gold reserves and what are its uses? The gold reserve is the amount of gold either in bars or gold coins held by the local central bank and is mainly intended to ensure the fulfillment of promises to pay depositors. So let's say, for example, you deposited your money in a US bank, okay? The US bank, which is regulated by the Federal Reserve Bank, should have any sort of metal or let's say financial instrument so that you can make sure that you can get your money back from the Federal Reserve or from the US Central Bank. Basically, it's not 100% applicable at the moment. This used to be many years ago. However, at the moment, it still somehow applies. Banks should have some sort of a reserve from a metal or a foreign currency, especially metals, on top of that is gold, to make sure that they have some sort of financial stability. They have something that's worth your money, and not only your money, but all of the depositors' money in the US banks. So this is why basically if you see that top countries are increasing their reserves from gold, this is definitely a bullish signal on the short, medium, and the long term. This means that it's not only you who is interested to buy gold, it's not someone who's a big investor. They are basically countries, and they are uh, buying gold with lots and lots of amounts. Of course, if it's on the other side and they are selling gold, this might be a bearish signal, depending on how much is being sold and what is the reason for that. However, just as a general rule of thumb, the reserves of central banks that is in gold is something essential to make sure that the financial system as a whole is stable on the short and the long term. Going forward, if you're trading gold, basically, and if you're new to trading gold, whenever you open the chart, I can guarantee that you will see big and wide movements on prices on the short term. You can see maybe gold going up for $30-$40 during 1 hour, or maybe going down $100 or $200 during 1 day. Why is that? Simply because there are a lot of factors and economic indicators that affect gold prices on the short and long term. What are those economic indicators? They are basically a lot. However, during this session, we will try to cover the most important of those, starting with number one, the interest rates. As we mentioned, interest rates are a key factor in determining gold prices because interest rates affect currencies. Currencies are another financial instrument because an investor is basically not interested in gold specifically. He's not interested in currencies or stocks or whatever. The investor, or let's say a good investor, will always look for the best investment opportunity to give him the highest profits with the lowest risk. So he's considering multiple financial assets to trade, whether it be assets, gold as metals, gold, silver, etc., whether it's energies like US or the UK crude oil. We are talking also about cryptocurrencies, we're talking about treasury yields and so on. So if you're an investor and you're faced with many, many instruments and many, many options that you're having to trade or to invest, you'll always look for the safest one. If interest rates are increasing on a given currency, this means that this currency will give you higher yields. This means that the value of this currency will increase because people will definitely rush to this currency. And this is what was happening with the US dollar. The Federal Reserve raised interest rates. Raising interest rates means higher yields on the US dollar. Higher yields means it's now more favorable for the investors to preserve their capital in the US dollar. So this increased demand on the US dollar for its increased probable yields, and this increased the US dollar value. On the other hand, gold is a loser in the situation because higher interest rates affects gold negatively on the other hand. However, if you are having the opposite scenario, if for any reason the Federal Reserve is decreasing interest rates on the US dollar, so if you have US dollar, you used to have 3% or 4% interest annually, let's say, and right now you will receive lower interest rates. It's not so favorable at the moment, so a good investor will try to think, what can I do right now to get more profits? And he will start to see other options. Gold is probably one of the other options to consider. So higher interest rates means it's basically bearish for gold. Lower interest rates, it's basically bullish on the US, on the gold versus the US dollar. So the interest rate on major currencies, especially on the US dollar. Why is it especially on the US dollar? Simply because the gold that we trade is denominated by the US dollar. We always see the chart as gold versus the US dollar. So this is especially why we concentrate more on the US dollar while trading gold. So the interest rate on major currencies, especially the US dollar, which is determined in the monetary policy meetings of central banks, is one of the most important criteria for influencing gold prices globally. And you can see this chart, let's say, I'm not sure if now you can see this. You can see this upward spike in gold prices that happened on the 22nd of March, during which we had a meeting from the Federal Reserve. They raised interest rates for 25 basis points. So yeah, higher interest rates, basically, we can see the effect on this on the markets. Someone can ask, yeah, but they raised interest rates, why is gold going up? Because we have other factors affecting people who were expecting a little bit more interest rates hikes on the US dollar, etc. Each meeting has its own condition. However, we were just explaining the general rule of thumb. Anyway, if you're having a Federal Reserve meeting or any other central bank meeting uh, that's taking place, make sure and brace yourself for a very big movement on gold prices. And this is exactly what took place on the 22nd of March. Other thing, and the second thing that basically affects gold prices, is the inflation reports or inflation statistics. What is inflation? As we explained at the beginning of the session, is the devaluation of the currency's purchasing power. If you can buy something today with $1,000, if after 1 month this the $1,000 is not enough to buy the same thing, so the price went up, this means that the US dollar value is going down, or the purchasing power is going down, and this is due to high inflation. Why is inflation really critical for gold prices? Because inflation really affects the interest rates on any currency. So let's take an example for the Federal Reserve. The Federal Reserve has one target, or basically two targets, first of which is to make sure that the prices are stable in the economy, and by controlling the inflation levels around 2%, which is the target for the Federal Reserve. So what happens if inflation is getting a little bit higher or a little bit lower than expected? So the Federal Reserve starts implementing some monetary policy tools to make sure that the inflation is stable around the 2%. One of those key reports that the Federal Reserve concentrates on is basically the inflation, because how can we decide the interest rates without knowing where do we stand when it comes to the inflation reports? So this is basically the secondary thing that we look for, which is the inflation reports. And basically we have two types of inflation reports. There are many. However, the most popular one is the CPI, or the Consumer Price Index, which is the weighted average of the prices of a group of consumer goods. Think of it as your basket of your monthly goods and services that you buy for your house, let's say, or your household. You usually pay $1,000, let's say, to buy goods and services that you need in your house for 1 month. And each month you're buying the same basket, you are noticing that prices are going a little bit higher. So from $1,000, the next month it's coming at $1,010, then $1,020, $30, and so on. So the same basket of goods and services, if it's increasing in price, this means that the consumer price index is going higher. Another way of calculating how inflation works is looking at the same thing, however, from the producer side of things, not the consumer price index, but the producer price index. And we don't really want to go into more details. However, I'm just explaining to you the broad fact that by measuring how much the consumer pays or how much the producer pays, we can know the inflation in the economy, and thus we can decide on interest rates suitable to keep this inflation at our target of 2%. This affects the US dollar value and hence affects the gold price. The third thing is basically the unemployment rates. We mentioned during the last slide that one of the two targets for the Federal Reserve is to make sure that inflation is kept stable at the target of 2%. The other target is basically to make sure that the unemployment rates are kept at its lowest as much as possible. So controlling the inflation, controlling prices, as well as maintaining the full employment of the labor market are the two goals from the Federal Reserve. I can see some people trying to raise hands at the moment. Maybe they have a couple of questions. You can basically leave your question in the chat box, and I'll make sure that by the end of the session, all of the questions will be answered, of course. So I'm not sure if we have this option to raise your hand. I will not be able to listen to you. Maybe your voice will not be so clear to everyone here in the room. So you can please leave your comment or your question in the chat box. It's available there, and I'll answer all of the questions during this session. So the unemployment rates basically is the second thing that we look for: inflation and the unemployment rates. When the employment rate rises, the currency becomes stronger, because simply when the employment is higher, the economy is stronger, the currency becomes stronger. And on the other side, if a decrease in unemployment rates could lead to an increase in the value of the US dollar, this could lead to a decrease in gold prices. So really understanding that when the employment goes higher, the stronger the economy is, and hence the US dollar is stronger. This affects the gold on the negative side, and vice versa. Having a look also on COVID effect on gold prices, I do really believe that most of you traders have witnessed what happened on COVID prices, or on gold prices affected by the COVID crisis back in 2019 and 2020. Simply put and straightforward, when COVID crisis hit in, all of the factories were shut off. All of the workers were staying at home. Countries and governments strictly applied some closures and some, restrictions to make sure that the COVID will not spread any faster. All of this basically affected the economic production very fastly and very, very greatly. And as a reaction to this, investors found nothing to do except buy gold to make sure that their US dollar, their capital, and their value of their money would be kept without any losses. So this basically we have seen some huge surge in gold prices. And this is what I'm talking about. If you're looking about the impact of coronavirus on gold prices, you can see that by beginning of March, we were just about here. And this is basically where we started to see some governments completely go into full lockdown on coronavirus. Gold was trading around $14.90 per ounce. And you can see how far we went from March till August, around 5 months. 5 months was basically enough for gold to go from $14.90 to more than $2,000 per ounce, just because simply people were very afraid from the consequences of the coronavirus on the economic output. And yeah, that was the safe haven that we had. And having another look on what happened basically back on 2022. Yeah, it was February of 2022, last year, around 13 months ago, when Russia decided, or Vladimir Putin, the Russian president, decided to invade Ukraine. This basically sent a lot of prices higher. We are talking about oil, gas, wheat, and other products. This was basically affecting the economic production in Europe, because gas was basically a key element in Europe for the production, for factories, for manufacturers to work, and so on. So we had this upward move in most of the prices. This means higher inflation. This means the currencies, either is it the US dollar, the euro, the pound, or whatever it is, currencies are losing their value. And hence, this is a very good opportunity for people to go and buy gold. And we had this another move to higher than $2070 per ounce, or $2070 per ounce during the corona pandemic we have had a higher high during this Russian invasion into Ukraine, and this is what we can see here. By the beginning of February, which is here, you can see that gold was basically trading around 1792. Okay, and you can see how quickly prices went higher to the levels of 2071. This upward move on gold was not basically something technical, however, it was pure fundamental and economic analysis that told us that investors, will definitely rush to gold to buy gold on the short and the medium term. Currently, what we're having on the gold prices is a banking system crisis. We've all witnessed during the past month what happened to quite a few of the US banks. Of course, we can see Silicon Valley failure. And Silicon Valley basically added some fears in the financial, or let's say a lot of fears in the financial industry. People were so scared that we will be having another financial collapse, just like what happened in 2007 and 2008. So people definitely just rushed into gold. Not only Silicon Valley, we had another few failures from Signature Bank, First Republic Bank, and at the moment we're speaking, there are around 6 banks. They didn't fully fail. However, investors are still a little bit scared from what's happening in the banking industry, let's say. So the banking crisis are among the things that most harm the economy of countries, and they occur when the value of financial institutions or assets decline rapidly, where these crises are accompanied by recession, accompanied by greater financial crisis. Okay, so this is what happened recently and continues until now in the crisis of the banking system in the United States of America. Yeah, not only this happened in the United States of America, but also in Credit Suisse in Europe, in Switzerland. At that time, great fluctuations occurred that led to a rise in gold prices. What happened back in those periods? You can see yet another surge on gold prices from the levels of 1800 roughly to levels exceeding the levels of $2,000 per ounce. So that's quite another big move on gold, and this was basically clearly due to the fact of the risk of sentiment in the markets. Currently, basically, as long as this financial crisis is still going on, as long as investors are not still 100% sure that the situation has been handled by the US banks, we are still expecting to see gold prices higher. And I do believe right now it's time to have a quick look on the technical analysis. And I'll have a look on. So right now, if you have any questions, you can leave it in the comments section. Yeah, we have a few people raising their hands. I'm afraid we cannot answer those by raising hands because I'll be able to hear you quite well. However, there is a chat box below. You can write your comments or your questions, and I'll make sure that it will be answered on the spot. How do we analyze the gold on a technical analysis basis? Because what I've done before this session is I've completely deleted all of my charts, deleted all of my technical tools, trend lines, support and resistance lines, and everything. I only have the 2 indicators that I'm working with, the basic 2 indicators, which is the squeeze momentum as well as the super trends. And we have basically had some webinars before teaching you those 2 indicators. However, nothing else is on my screen. Today we're going to have a quick but detailed technical analysis on gold prices, and let's start with the weekly time frame from here. This is basically what's happening on gold prices since 2020. So this upward move was the coronavirus. okay? And this was basically 2020, from March till August of 2020. We had another sideways move, another upward move here to the previous high, and that was basically the Russian invasion into Ukraine. And again, another move higher here is basically the banking crisis that we just mentioned. So yeah, we have three highs. This is the COVID. This is the Russian-Ukraine conflict. And the third, this tiny one, is basically, let's say, Silicon Valley Bank failure. And this basically explains to you that, yeah, you might be a very, very good technical analyst. However, when looking on gold prices, you need to know what basically moves prices. And as we discussed, there are multiple reasons. So this COVID-19 was basically a great or a major health crisis. The Russian-Ukraine conflict is basically a geopolitical tension, military conflict, and the Silicon Valley Bank failure is basically an economic and a financial crisis. So all of those different types of crisis affects gold prices. So yeah, let's have a look on what's going here on gold prices. And this is what I can see on gold prices at the moment. It's simple. It's a very, very clear bearish price channel. You can see that every time we form this historical high, it's slightly lower than the previous one. So the first one was basically here around 2070. The other one was around the same levels. However, it was just a tiny touch before going down back to the levels of $1,650 per ounce. And the third one was basically another touch to those levels. So this is a very, very clear level of resistance here, just around the levels of $2,000 per ounce. What's going and what's happening at the moment here on the weekly time frame is that you can see this is what we call as a bearish divergence. So the last higher high on the US or on the gold versus the US dollar, although it was a higher high on prices, however, it was a lower high on the momentum indicator. So this tells you that the upward move wasn't basically very strong enough with momentum that we can believe it can sustain. So on the weekly time frame, the outlook so far looks bearish to me on the gold prices. Okay, and having a look also on the daily time frame, you can pretty much see the same. So it was an upward move, a retracement here, and this is, to me, a double top taking place around the levels of $2,000 per ounce. So we reached those levels on the 20th of March. We have retraced a little bit, another test to the levels again of $2,000 per ounce, and it seems that this level is holding very well as a strong resistance on the daily time frame. Looking on the 4-hour time frame, you can see, yeah, this is what I'm talking about. High, high again. The key price for me on the short and the medium time frame is the 1934. As soon as I find a break, close, and a retest below the 1934, I'm definitely shorting gold. With $62, let's say, my target would be the 1885. This is what I'm looking for on the short and the medium term. However, this is based on the technical side of things. If you want to trade gold during this period of financial crisis, make sure that tomorrow or maybe after a couple of hours from now, you might see a headline that another US bank is facing some liquidity crunch or some crisis, this will definitely just disregard our technical analysis and send gold prices higher. What I want to say is, if you're trading technical analysis on gold, make sure that you stick to your stop loss. Make sure that you don't risk more than you can afford to lose, because things can go wrong when trading gold on the short and the medium time frame. So that was our session for today. We had a very, very thorough look on the fundamental side of gold prices, what will happen in the next period, and we also discussed briefly on the weekly, daily, and the 4-hour time frame our expectations on gold prices. Please make sure that you register for our next session that should be on the 30th of March, same time, 9 p.m. Dubai time, which is 5 p.m. GMT. We will be discussing oil markets. Oil also has been going through some very, very, this is what I'm talking about. We are having some great moves on the US oil, of course, supported by some economic recession expected, Russia and Ukraine. What are the fundamental reasons affecting the US oil, etc., etc.? We'll be discussing this in a specific session for the US oil next Thursday, the 30th of March, 9 p.m. GMT time. Thank you so much for your attendance. I'm excited for our next one. We will meet up again on Thursday. Thank you, and please stay safe.